Thank you very much, Yuri, for your introduction, and good afternoon, everyone, and thank you for joining us today. So today we are going to talk about not we're not going to talk about how to cover our day-to-day expenses, but like paying your bills, paying your mortgage, paying for groceries, or so on. So that's we usually do on our regular budget, but about how we can financially handle different life events that happen in our lives, and sometimes unexpectedly when we are not prepared for them. So here are some life events we're experiencing in our life, and yeah, we go through. Usually, we plan for most of these events in advance and prepare for them financially as well. But some events cannot be predicted. Yeah, definitely. Like you can see, the sending child to school or going to college or on training. Most of it we can plan and set up special accounts for that. But sometimes we lose the job and we have to go training or our business going down, and so you have to go get education when you didn't plan for it. Get married, definitely you can plan through this, but separation and divorce can be unexpected as well. Lots of family events like birth of the child or adoption, celebrating the birthdays or baptismal or other rites of passage events. Some medical expenses may be very high and unexpected, caring for disabled and their aging loved ones. Funeral expenses, sometimes we can plan for it, sometimes they come, unfortunately, very dramatic way, and so on. So you can see most of these events, which goes over our budget. So we have to think about about them in advance. Uh, so the best way, and financial experts say, the first what you should do to get prepared for those events is set up your emergency funds. That's the first step of building of your savings. So you calculate your expenses, so you will know how much remaining income you can have aside. So experts recommend saving up to 6 months of your expenses for emergency fund. So if something happens to you, or life happens, so you have at least that. So you also need to make regular contribution in your savings. Experts suggest that you need to put at least 10-15% of your monthly income into your general savings, starting as early as 25, when you're 25-year old, and make additional contribution if for special savings programs like you're planning for the car, or saving for down payment and so forth. And for that, you set up the separate savings account, so you don't mix them up together. So the retirement is separate, the education like our ESP is separate, probably saving for a new car is for down payment is separate. So the better you organize, the better you get prepared for some unfortunate events which may happen in our lives, and they happen and will happen. You probably want to buy appropriate insurance coverage, so you have at least financially prepared for those events. And the last not least, set up the credit facilities so you can use them when the need would come to you. Okay, so what are my options if I need money? So I just want to go through this nine options, and I believe they cover pretty much a lot, the sources we can get money for emergencies. So rarely anyone gets opportunity to go through life without having to borrow money. And of course, many people borrow money to buy a house or a new car, and you can prepare for these events. But the kind of borrowing I'm talking about here is to cover unexpected life events, which may come uninvited as monthly cash shortages or emergencies. Uh, but keep in mind, the most of these money borrowing options come with a high interest or other terms and conditions that could create more financial stress in your future if you're not prepared for them. Uh, Many Canadians rely on a debt to navigate lives. I cannot imagine who can buy a house without taking the mortgage, or buy a car for cash. Canadian household debt now is 177% of disposable income. It's pretty high. It's a 2020 numbers. Um, so the Statistic Canada says the key measures of household debt rose in the first quarter of this year as the COVID-19 pandemic began to hold up the economy. So the same Statistic Canada added that annual trend showed the lower income household tended to have a higher debt to disposable income ratio. So overall, it says credit market debt totaled 2.3 trillion at the end of the first quarter to 2020, including 150.53 trillion in mortgage debts and 802 billion in consumer credit and non-mortgage loans. So it's a pretty high load, regardless of the reason you may face situation where you need to take on debt, keep moving forward. But the type of the debt you take on could really take a toll on your financial health. So you probably heard good debt, bad debt, but remember, debt is debt. If you have to borrow money, do it responsibly with a reasonable plan for your repaying the debt as soon as possible. You should also be sure you know precisely how much money you need to borrow and what your monthly payments you can afford. So some basic loan features. So what's the difference between revolving and installment debts? So installment debt credit basically is credit. It's a loan which offer borrower the fixed amount of money over a specified period of time. So this way, you know upfront how much you get on the first day and how much you would pay on a monthly basis, or they call it installments, the monthly payments. So we need to make and how much interest you pay. So you know exactly everything. Everything is spelled out. You borrow in specific dollar amount for the loan, and the payments, interest rate, and length of term, everything is known up front. It can be easier to budget for installment loans since the monthly payments are predictable. The revolving debt, in contrast to installment credit, revolving credit extends borrower line of credit with no determined end time, and they can span up to their assigned credit limit. It's ongoing open-end credit obligation. One of the biggest example of revolving debt is the credit card. So the card holder routinely make charges, so you can charge whatever, pays them off, whether in full or partially, makes more charges, and so on. The amount of money you borrower uses within their credit limit is up to them, and so you decide how much you want to charge. There is no set monthly payment plan. So the borrower has the option to pay their balance off in full or in part. So you can pay minimum or carry or revolve. So the balance to the next month. So that's up to you. And lump sum payment loans are those where you receive the fixed amount at the beginning of the term, and it had to be paid in full at the end. So you get whole thing at the beginning, you have to pay whole thing at the end. So there is no payments in between. So in most cases, there would be no interest payments. So some loans, the financial institution want you make interest payments, but some don't, and some charge your interest payments at the beginning out of the amount they give you, or at the end. So you pay the whole thing at the end plus interest. So the next feature is fixed rate loans and variable rate loans. So fixed rate loan has the same interest rate for the entirety of the loan agreements, the term period of the loan. So while variable rate loans, have an interest that may charge over time, depending on a specific formula, which is predetermined from the in the loan agreement. So you know exactly what the formula would be. So some examples, it's a prime attached rate. So let's say Ukraine Credit Union line of credit, that's a prime plus 3. So prime is 285 at the moment, so that will be 585. So if the prime goes down, let's say to 2.5, so your interest would go down to 5.5. If interest goes down to 3, so prime plus 3 will be 6%. So your rate may vary. The next is definition is amortization and term. Amortization is the length of time it takes the borrower to repay a loan in full. So from very beginning, you got the loan and you pay to the zero and it's done. Term is a period of time in which it's possible to repay the loan, making regular payments as agreed, and within predetermined conditions. So basically, that's it's term for agreement. So you know exactly your interest rate, you know conditions, term ended, you still have balance, so you renegotiate the term. So term this way is a portion of the amortization period. Frequently, financial institutions offer loans where the term is shorter than amortization, like mortgages, for example. So amortization for mortgages may be 20 years, 25 or 30 years, but the term will be 1 to 5 years. Large car loans, let's say for the Ukraine Credit Union, if you take the new car loan, like 30, 40, $50,000, we can allow you have amortization for 8 years, but the term may be 3 or 5 years. And then after the term ends, you may decide if the rates would go down, so you can renegotiate and get it down, or pay it in full, or if you sell the car, you pay the whole thing. So you have the balance. Amortization when no balance left after the end of the amortization term. And the loans can be secured or unsecured. So secured loan is connected to certain piece of collateral, something valuable like a car or home. Like mortgage is a good example. Car loan is a good example. With a secured loan, the lender can take possession of the collateral if you don't repay the loan as you have agreed on the loan agreement. So let's say if somebody cannot pay the mortgage, yeah, definitely we go through the lengthy process, but at the end, if nothing good came out, then the financial institution can sell the house or possess the car and sell it to cover the loan. And unsecured loans an unsecured loan is not protected by any particular collateral. It doesn't mean the financial institution cannot go after some your property. It can, but there is no particular collateral. So the financial institution can go to the court and then try to get hold on some other assets you have. So our options. The first option was taking out the personal loan or arranging line of credit. So take a look at this. So personal loan is usually the installment loan. So remember the installment loan, you get the whole thing from the beginning. But it may be lump sum as well. So you pay down until you pay down the whole thing. Or some payment loans you take and you pay the whole thing at the end. Usually term is the same as amortization on the personal loans because they are smaller and the term is like 5 years, 4 years, 3 years. Line of credit it's a revolving credit with no amortization term. They both personal loans and line of credits can be fixed or variable rate and can be secured or unsecured. So the second options we were talking about, it's a equity mortgages or the home equity line of credit. So the mortgage loan, and we were talking, if you homeowner, so you have equity, you may have equity in your home. So usually when we say the mortgage, we mean you buy a house and you have a down payment, and the difference is a mortgage loan. But if something happens and you need extra money, let's say to fix the roof, or to do the extensive renovation, so you have equity in your house. Most financial institutions will allow you to take up to 80% of the market value of your house. Um, the difference between the mortgage you have, and some people don't have any mortgage at all, and the 80% that equity loan. So home equity line of credit is essentially first or second or third mortgage, depending how many you have you had before, in which you borrow money using the equity. Uh, Home equity line of credit is a revolving line of credit secured by equity in the home. So both of them, mortgage and home equity line of credit, they're mortgages. They're registered on your title, but the mortgage is an installment loan, and the home equity is a line of credit, which has no amortization term. Both of them can be fixed or variable rate loans, but they always secured by real estate. So the third option, it's credit card balance transfers. So yeah, definitely, I guess you all have credit cards, and use from time to time you receive offers in the mail, which suggests 0 to 7.99 balance transfer percent from credit card companies. Sometimes if you already have the credit cards, you may have convenient checks in the mail that you can cash or send to use to pay the other debts. Uh, it is very good option actually for the quick fixes if you need money quickly. Uh, the only thing, you should proceed with the caution if you're considering this borrowing option. So you need to remember to pay the transfer balance at the end of the promotion term. Sometimes they offer you 3 months, 6 months, 9 months, 12 months. So if you take this, it's easy option. You don't need to provide any documents. They don't pull out your credit. So it's easy. You just say, I want it, and you get it. But if you paid at the end of the term, yeah, you are the winner. Uh, and if you don't have money at the full balance, then you just come to Ukraine Credit Union, talk to your lender, and we may help you to get that consolidation loan to pay that balance you have, which you cannot pay in full. Because if you don't pay at the end of the term, then the full interest rate will kick in, and it's about 20%, and sometimes it's more than that. Using credit cards or taking cash advances. Yeah, we use it all the time. So we need to pay whatever, funeral, medical. And they accept the credit cards, definitely use it. If you receive the statement and by the end of uh, grace period, you pay the full balance, you pay no interest. And even on the most Calabria MasterCard, which Ukraine Credit Union offer, you can earn 1 or 2% on when you use the card. So you get money back on those cards. So it's a great option if you pay it at the end. But if you cannot pay it at the end, just come to Ukraine Credit Union lender, talk to the lender. We can do debt consolidation loan, so it's not high interest on them. You have time. You have time at the end of the statement, and you have time to the end of the grace period. Taking cash advances a little bit. It's bites, because when you take the cash advance, it charges interest, and it's a high interest, like around 20%, whatever your card charges, right from the day one you use your cash advance. So remember, use it only if you need cash, not, you cannot use the credit card or anything else, and you can repay it quickly. So don't wait until the interest builds up. If you cannot find the cash or whatever you plan on, It didn't happen, so come to a financial institution and talk to the lender how to refinance that. Yeah, borrowing from retirement accounts. Who didn't use that one? So we all save into our RSPs. Some old enough to have the RIF. We have TFSA and other retirement accounts. So again, you need to understand how that works because, for example, if you take from RSP, you cannot reinstate your room. So if you take it out, you cannot put it back when you have money. So it's gone. Plus, you would pay taxes if it's 5,000 or less. There will be 10%. If it's between 5 and 15,000, it will be 20%, and you pay it upfront. And if it's over 15,000, they will pay 30% on a withdrawal tax. So it's quite a hard option, but if you have to, you have to. TFSA, on the other hand, is much better in that sense, because if you take it out, so you can put back in. But again, you have to remember, so you don't put back in during the same year. So in any case, come to Ukraine Credit Union, talk to the specialist, and we'll give you the best advice how to use that if you have those retirement accounts, and that's the best option for you at the moment to cover your emergencies. Peer-to-peer borrowing. Yeah, that's not all people heard about this. Actually, one of the options, the private mortgages, you heard that. So basically, it's when I borrow money from people like me. So you don't use the financial institution on the middle. So you borrow directly from the people who wants to lend the money to you. So the private mortgages would be one example. The second, you probably heard about the crowdfunding. Some websites, they will help you with this, especially for people who start in the business and they cannot get any financing for the business plan from financial institution because you're new, it's risky, whatever the financial institution reason they don't want to give you money for. So you state on the website your reason. So what's your business plan, what you're going to use money for, how you're going to repay, and then you get your condition, so you can get your financing. The only not the only disadvantage, but disadvantage, because the rate is usually pretty high. It's from 7 to 35%. So it's very often it may be very expensive, but the only option you can get money for the reason you're borrowing money for. But again, that's the option available, so you can think about it. Borrowing money from friends and family. So the rule of thumb is don't borrow from friends and family ever. That's because it's the surest way to destroy important relationship. However, there is a case to be made for borrowing from family and friends in a pinch. First and foremost, don't ask a loved one to borrow money without offering something extra in return. You might be Uncle Joe, favorite nephew or niece, but kind-hearted Uncle Joe is entitled to receive some benefits for helping you out. So it's also important that you fully commit yourself to abide by the terms of the loan set forth in the written agreement. And you must do the written agreement because otherwise you're just setting yourself for disaster. Again, this is a convenient way to borrow money. It is also going to be potentially put the strain on your relationship until your loan is repaid. This is a situation where you need to be very mindful of the love motivating your friends and relative to help you. So be very, very careful with this. Okay, some people, in case of emergency, what they do, they sell in their personal items like jewelries or car, even house. And the problem with this, you probably would sell not in the best time. It probably, the money you would get for it would be much, much lower than if you do it properly without rush. The same is pawning personal items at the local pawn shop. So but if you face an emergency and you need cash fast, It may be the only option you have. So that's the option you have. So just remember, so you don't get, at least you would get about 50% or less of your assets, which really worth the thing you're offering as a collateral to get the money. The qualifying assets could be most anything that has value. So, and sometimes it has the sentimental value for you. And in case you don't pay and buy it back, so you may lose, lovely jewelry, which has some memory for you, or artwork, or collectible coins, or currency, antique guns, or memorabilia, whatever it is. So be careful with that. So the last option is taking a payday loan. It's in extreme cases, and it should be always resort, the last resort you would use for borrowing money or getting money for emergency. Interesting, the payday loans in Canada are permitted under Section 347.1 of the Criminal Code, and Ontario. So the maximum, the maximum cost of borrowing of a payday loan, and payday loans usually they count like in hundreds. They can charge you a maximum up to $15 per hundred, but it's for 2-week loans, and you can get as many loans as the borrower will wishing to give you. But if you calculate the effective interest rate, the annual rate is 3,724%. So, which is crazy. So it has to be really, really last resort when you're thinking. You can see the comparison even with the credit cards, because credit cards, taking advance on the credit cards is expensive. And in this example, it's 23%. So for the one loan, 300 loan, you'll pay $45. On the credit card, if you take cash advance for 2 weeks, you'll pay just $6.15. If you take 1,800, the last line, it's only 1,800, you would pay for 2 weeks, $270. On the cash advance, you pay just $36.88. That's it. So before you using it has to be really last resort using, if nothing else works for you. So the other thing I would like to say, so when you come to the financial institution or whatever borrower, it may be private borrower, the borrower wants to know the 3 things, and you need to be ready for answer those questions. So first, and very important, the borrower ability to repay the debt, because nobody wants to give you money knowing that you don't have enough income or whatever sources you have to pay debt back, because you're heading for trouble. The second, the borrower's willingness to repay that, and how I protect it if everything goes wrong. So what's the ability to repay? Basically, it's your income. So usually the financial institution will ask you how much you income make. Not only you make, it may be rental income, whatever, your spouse income, it may be disability payments, it may be lots of other payments you get, but it has to be consistent, regular payments. And then expenses you have to, those mandatory expenses you have, and we calculate the ratio. So you can see it has to be 42 or lower percent of the whole mandatory payments you're making compared to your gross annual income. So then we say you have good ability to repay the debt. If it's more than that, then it's a risk that something may happen and you won't repay your loan back. The willingness to repay is basically how disciplined, how you behave in the past. Usually, we start from credit history. It may be history with financial institution, because some people, they make a lot of money, but they don't honor their bills. They don't pay on time. They forget to pay late, or argue with financial institution for any cent. So those financial institution or lender doesn't want to deal with the people like you have to fight over. So if you make enough money to cover your debt, if your credit history is clean and nice, so we know you're a person who respect others and you paying debt, so we would be willing to give you. And life happens. Sometimes you have a good income, you have a good credit, but disease may happen, death may happen in life, everything may happen, everything may go wrong, and whatever we based our decision on, it just disappears. So what we're gonna do? So we ask for collateral, those secured loans. So they could be saving accounts or term deposits or GAC. We call it liquid secured. So you basically offering the cash, and that's the easiest and cheapest way to borrow, because we have kind of 100% to cover in case something happens. The second best option is house, whatever you have, detached, semi-detached, townhouse, condominium, co-op, whatever house you have, we can take it. We won't give you 100%. I mentioned for detached, semi-detached house, it could be 80%. Condominium could be 75. For co-op, it may be 65. But talk to your lender, so we'll discuss it and find out what you can get for it. The car items will, whatever you buying, it may be bicycle, a boat, whatever item you take a loan for to buy. Many financial institutions will take as a collateral investments, stocks, bonds, mutual funds you have, but usually nobody would give you more than 50% of the value, or even less than that. Especially for the business loans, it could be business property you have. So yeah, and sometimes the lender would take the general security agreement on all persons' property. So you kind of pledging whatever. It's not a certain property, but everything you have to support the loan. And in many cases, in some cases, a financial institution, we may ask for assignment of wages or assignment of rents. So if, let's say, if it's investment mortgage and the person doesn't pay for the mortgage, according to this assignment, the financial institution or lender can go after and collect the rents to cover the payments. So, on the final thought, I presented you 9 different options for borrowing money when you're back against the wall. As you can see, each option has pros and cons. All of them can end up in costing you a lot of money if you don't understand the loans or can't repay them back on time. Before you decide to pursue any of these borrowing options, you'll want to carefully consider whether the loan is to pay for needs or wants. So you really need it. You really need that money. Then you have to do what you have to do. In the end, pursuing one of these paths will hopefully motivate you to save up for emergency fund as soon as possible. So I would suggest, think about building emergency fund, starting your savings, and talk to the specialist. I would suggest Ukraine Credit Union, lender, or specialist. Talk about the options. So make sure you have ready something set up, like line of credit or home equity line of credit or anything, something else, in case something happens to you. So thank you for your attention, and I'm ready to answer any questions you may have. Thank you.
Thank you, Vlad. That was very thorough. Do you think, how often do people, when they get a mortgage, do they also get like a line of credit along with it? Because let's say they're putting a large down payment on.
See, it's at some point we start, because especially in Toronto, the values going up quite quickly. So we know at some point by paying the mortgage down, and the value goes up. So it will create some equity caution So we suggest to register line of credit, even though you don't have room yet. But by setting this up, you're preparing yourself in case the need. You just come. It's a simple application. You don't have to go through the legal stuff, pay extra. So you have everything prepared. It's just much faster, because setting up home equity line of credit or mortgage, it takes like 2, 3, 4 weeks. But if you, as you suggest, you setting up at the beginning, then it's ready to go. It's maybe like 2, 3 days, and boom, you have it available. So yeah, I think it's a very smart idea to set up. If there is no room, at least set up the line of credit
I
and
think
get the credit card.
that's interesting that you should say, because I bought a house recently but before I bought it, I wanted to extend my line of credit, and I should have done that, on my old house, because I had to go through the whole rigmarole of getting because I only had, I think, $60,000 maximum on my line of credit, but I wanted to raise it. But with the new
Right.
house, I just said, give me the maximum you possibly could. I may not be using it, but that way,
Right.
only a certain amount of it is open to use right now. But if I want to, 3 years from now, if I paid off my mortgage, I could extend it to the full available amount without having to re-register mortgages and blah, 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 and all that. So it's actually quite useful. Anyway, I don't see any questions at the moment. A question just popped up. So it says, when is the ideal time to apply for a loan? Is it a mortgage loan? Is it at renewal, or any time that which provides a better rate mortgage loan, or a HELOC? So is there sort of an ideal time to?
Well, we were talking today about the some kind of unexpected events. For this, the best solution is even home equity line of credit or line of credit. Home equity line of credit, definitely the best option, because it's a lower interest rate, the bigger amount. So I know I've done home equity line of credit for $800,000. Or $600,000. So you can set it up in advance. You don't have to use it. If you don't use it, you don't pay any interest on it, but it's ready to go. If you decide, whatever, to buy investment property, to buy cottage, to buy a new car, that's the cheapest, and it's ready. You don't have to. The mortgage, as I explained, that's installment credit. So when you set it up, you have to take the whole thing up front and start paying interest on it and installment payments. You don't want to do this if you don't need it at the moment. But line of credit, that's ideal credit facility for this, because you don't use it, you don't pay anything.
And in your experience, how often do people use their line of credit for things like investing on the market? Because, especially over the summer, where the market took a tank related to COVID. I mean,
Not often, but some people do, because it's called leveraged investment. And actually, the every investment dealer would watch for those accounts very closely, because it's very risky. Because if your leverage would go down, so you can lose all your money and all your investments. So,
well, but that's if you borrow from the brokerage. If you're borrowing on your line of credit and buying the shares at their full value, then you don't have to worry about
yeah, but as I mentioned at the end, I remember the teacher of the Warren Buffett once said, so the problem is not speculation or investing. The problem is when people think they invest, but they really speculate. So if you know the rules, you know what you're doing, so you know what's the risks are, and you prepare for them, then you won't lose. You won't, it would be no unexpected events. So you know how you're gonna behave. You have a plan. So you always need to have a plan what you're gonna do. And
you also have to stick to it, because having a plan is great, but if you change your plan halfway through, you may find that made a big mistake. Anyway, so I think that's it for questions. Thank you very much, Vlad. Thank you everyone for joining us. We're going to put a recording of this up hopefully by tomorrow. Here, there's another question. So how do interest rates compare on mortgages to equity lines of credit?
Yeah, so yeah, if you're talking about the price and interest rates, the mortgage, that's the lowest. For example, now it's 229, and for the line of credit, there will be prime plus one, so which is basically 285 plus one, which is 385. So you can judge. Yeah, that's the difference. Because what you need to remember, the higher risk, the higher price. The lower risk, the lower price. The mortgage has a lower risk for the financial institution, so that's why the financial institution will price it lower. Line of credit, yeah, it's more risky because you can reborrow. It's revolving credit. You can reborrow up to the limit anytime without warning. So that's more risky, and it's there is no guarantee. So if you have a mortgage, I know I have that money. I can make money on them. You pay your payments. You pay interest on the line of credit. You can set it up and take nothing, and I earn nothing on it. So that's why it's more risky. Yeah, mortgage is the best from the point of the price, but line of credit is the best from the point of you have it when you need it, and you don't pay when you don't need it.
Right. And out of curiosity, obviously on an unsecured line of credit, your credit score becomes a very important factor in when you're going to get it. Is it as important on mortgages? Let's say you're taking a small mortgage against a big house, but you have bad credit. Would that prevent you from getting a mortgage or not?
Well, as I mentioned, it's a three question any lender may ask you. But again, as you mentioned, if it's a small mortgage on a bigger house, we can, and actually we have a special programs. One program for seniors who has no income, no credit, and we still give them the mortgage up to 30%. And for the people who has bad credit for different reasons, life happens. Sometimes it's out of your control. So we would give you up to 50% or up to 65%, even if the credit is not good. So, but again, for details, please come and see our lenders and we'll explain that programs in detail. So definitely, even if you have bad credit, I have my case when the person had just went out of the bankruptcy, just moved out from Alberta, divorced, filed the bankruptcy, and we gave them the mortgage. And now that member has excellent credit, happy living, found the partner, and they live happily ever after.
Yeah.
So yeah, that's the credit union for. So we'll find a way to help you.
But of course, it depends on every individual case. I mean,
That's correct. That's correct. We'll look at this into details and do whatever we can do to help you.
Okay, well, thank you very much, Vlad. And
thank you.
Everyone who's listening, I encourage you to join us on our last two webinars coming up for this season, and keep an eye out on our website for any new ones that we're going to schedule either in late January or beginning of late January or early February. Thank you very much and have a great rest of the day. Talk to you later.
Thank you.